Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage Eitel.
All right, my name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And friends, you are in the right place if you've got questions, if you're pulling your hair out, if you're yelling at your TV, if you're scratching your head, wondering what's going on with real estate, what's going on with mortgages, interest rates. Guys, we do this each week right here, same bat time, same bat station, and it is our goal to give you the information that you need, the tips, the tricks, the strategies, and of course, answer all of your questions so you can go out there and make better real estate and mortgage decisions for you and your family. Hey guys, and if you've got questions, give us a call, shoot us a text. That number is 855-462-7292. That's 855-462-7292. Jen, my producer, is standing by, womaning the Anytime hotline. She'll get you on the air. If you'd rather shoot an email, you can do that by visiting MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, type away, hit send, and she'll read your questions on the air. But man, oh man, what another crazy week, right? CPI numbers, job numbers, what's going to happen with the economy? Is this a recession? Is real estate still a good investment? I don't know. The whole thing is fascinating to me. And yes, I believe real estate is still a good investment. I believe historically it's proven to be a good investment. We run through the data all the time, and we're going to do that again today. Hey, but I want to share something interesting with you. I've had some fascinating conversations this week with clients and potential clients, and one gentleman in particular is a European gentleman. He's been over here he's been in the States for, I'm guessing around 25 years, if I remember correctly. And he's negotiating to buy some commercial property. And he's only focused, as most investors are, of commercial property on the cash flow. He doesn't care about the price. He doesn't care about the cost of the money. He's looking at the cash flow because he wants to park cash in equity positions into real estate and realize positive monthly cash flow, while more importantly, protecting that equity, protecting that investment. And his attitude is, with what's happened in the banking sector and primarily that Credit Suisse takeover by UBS, the Credit Suisse bondholders lost $17 billion with a B dollars overnight. All of the banking officials were negotiating this emergency acquisition by UBS, and they wrote down $17 billion in investors' cash to zero to make that work. Now, there's a lot of litigation in the process over there, and they're talking about lawsuits and that whether this was legal or not. That's beside the point. For today, tomorrow, and the near-term future, that money's gone. And guys like this gentleman are super concerned by that, and he's reallocating his cash in more secure places, real estate being one of them. And again, his primary focus is cash flow. And it sparked a conversation because in real estate, we primarily talk about residential real estate. Most people only ever own their own home if they own any real estate at all. So we're purely talking about equity. Now, equity happens when you pay down your loan balance or your property increases in value or a combination of both. So traditionally, someone will pay $200,000 for a property. Over time, it'll be worth $300,000. They sell the property, they realize that $100,000 gain. They're happy, they go do it again if they're lucky, right? That's realizing a gain, realizing an equity gain. But cash flow is important too, more important than just that equity position, because you can't pay your bills with equity. You can't buy your groceries with equity, but you can with cash flow. So that's why the focus is primarily on cash flow. And again, not concerned with price, not concerned with interest rate, just looking at cash flow. And I find it interesting because regardless of the asset class, we have a tendency only to look at the resale value of anything. But with real estate, it's super interesting because if you approach that same $200,000 purchase and you put $40,000 down and you borrow $160,000 and then you put a tenant in there and that tenant services that debt for you and throws off a positive cash flow, right? Cash flow. Now that $40,000 investment is earning you cash, but that property's also gaining equity unless the world ends and the market crashes. And guys, we've talked about that numerous times. We're just not seeing that happen. But I just find it fascinating because it's one asset class that allows you to leverage the lion's share of the acquisition price, allow someone else to pay that off for you while you benefit from 100% of the positive cash, all of the benefits of ownership with write-offs, with any, tax benefits of ownership. And then at the end, you realize all of the gains. I mean, show me a better scenario to park some money in. And I get it, right? Crypto was more sexy. Startup stocks are sexy. We had the tech bubble. There's always a sexier class of investments. But when you talk about, past performance and stability and the opportunity to leverage the asset and produce cash flow with self-liquidating debt, if you will, because someone else is paying it off, that's where real estate gets super exciting. And guys, I'm not saying it's right for everybody. I absolutely am not saying that. I had an instance this week where I advised the client against purchasing because it just doesn't make sense in their financial scenario. They're paying rent in a building at a ridiculously low amount. They wouldn't even qualify to buy that apartment if it became available today. They're better off to act as if they own a property and take that extra money that they would be paying each month in the form of a mortgage, keep that low rent and move that money off to the side and save up some money, work on their credit. And we put a plan in place for them. We're going to help them do this. Not now was the answer. We're going to get them ready. In the future, they're going to be a fantastic candidate to buy real estate. But I don't want you to mistake what I'm saying that this is right for everybody. Because if you scroll through social media, you will see countless numbers of people out there saying, renting is 100% interest. You're throwing your money away. Guys, no, it's not. You're not paying 100% interest in rent. Now, I understand what they're saying. You gain none of the benefits of ownership. So there's some logic in it, but I'm not a catchphrase guy. I'm not a date the rate, marry the house guy either, because I don't like the idea of buying something now with the assumption that you're going to be able to refinance it later, because we don't know that that's going to happen. That is super, super speculative. I'd rather buy something now, buy the interest rate down if possible, and manage myself accordingly. So anyway, guys, I don't mean to turn that into a diatribe, a long-winded intro, but I just find it fascinating because right now we're still seeing a tremendous amount of opportunity in the world of real estate, and supply and demand is still at work in values, and we're just not seeing values come down consistently across the board. And to the contrary, guys, numbers were released this week showing February house numbers as far as unit volume was up, but so were prices. So is the party started again? Is real estate the place to be? I don't know. I'm here. You're here. I'm happy that you're here. But you hear the music. You know what that means. That's my cue. We'll be back in a few. Sit tight. On the other side of this break, we're going to dive into more of the data and start taking your questions right here on the Mr. Mortgage Show. Let me tell you a little story about a man named Jed. Well, this is not a story about Jed, but it is a story about Mary. Mary is an awesome single mom who's been raising her daughter in a 1-bedroom, 1-bath apartment for the last 11 years. That's right, 1 bedroom and 1 bath. Hey, they've made the best of it. They've got bunk beds in there and it's worked. But her daughter's now a teenager and it's becoming a challenge, especially sharing that bathroom. She decided to jump in and become a homeowner. We got her approved with an FHA loan. That's right, I said it, FHA. Hey, if your agent's telling you FHA and VA loans are not getting accepted, you are working with the wrong agent. Contact me and I'll get you in touch with a really great agent. Hey, but back to Mary. She jumped in and she is now a proud homeowner. They have their own bedrooms, but more importantly, their own baths. They couldn't be happier. Guys, if you'd like to learn more, check out MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are tuned into the Mr. Mortgage Show. Hey, if you've got questions or comments, just call or text 855-462-7292. That's 855-462-7292. Jen, my producer, is standing by, manning the Anytime hotline. Actually, she's no longer standing by. She's already on the phone, so I know we've got some questions back there already. I guess I must have kicked the ant pile with that opening segment, but I appreciate everybody letting me rant about the benefits of real estate ownership and cash flow versus equity. Hey, if you missed that, check out MrMortgageRadio.com. It'll be a few days, but today's show will be posted up there as a podcast episode, MrMortgageRadio.com. If you enjoyed the show and you want a little more of it, some things you don't hear on the air, check out MrMortgageRadio.com. And that top link, I believe it is, takes you to the podcast. Hey, and you can also scroll to the bottom of that page, click the email icon, and send us an email if you want your questions read on the air that way. But speaking of your questions, and Jen, let me toss it her way for the first question of the day. Hey, Jen, what are the folks thinking?
Michelle is asking, I tried getting an equity line and my bank tells me I have a second lien with HUD and they can't do it. I did refinance my FHA loan after the COVID payment freeze, but never took a second mortgage. Have you ever heard of this? I think my identity might have been stolen.
Hey, that's interesting. So I'm not sure I would jump to the identity theft thing yet, but maybe what it sounds like to me, and I'm happy to look at the paperwork, and I understand why this would hinder the bank, but I might be able to give you a workaround too. So there's something called I think it's called a standalone partial claim. Don't hold me to that. I might have the technical term a little bit foggy, but that moratorium, if you will, you come out of that and you haven't made a payment. There's an accrual of interest. The loan needs to be modified. You owe them money that you've not yet paid. So sometimes there's a few ways that it can be handled. Sometimes the loan is completely modified and you're starting from that day forward with whatever the new payment and the new balance is. But in some cases, it's easier just to restart your payments and take that money that's owed, right, that you didn't pay, and they can put it on the back, right? You hear that term, we put it on the back of the loan. Well, oftentimes that's a standalone lien that needs to be satisfied. The fact that you said there's a HUD lien, I'm thinking that might be what happened. And the bank's hesitancy to do an equity line is that equity line needs to be in second lien position in most instances. 99 out of 100 times, the bank wants to be no lower in the lien hierarchy than second position, which means if you go into foreclosure, the taxes are paid first, any municipal liens, then the first mortgage. So the government's always first. The first lien's then paid, then the equity line, or if you had a second mortgage. Rarely will an equity line go behind a second mortgage, which would then put them in third lien position. So if they just did a title search and they see that second lien, they don't want to be in third place. Now, here's the workaround. If you bring this to their attention, you might have just been working with somebody who's not seen this before, right? I'm one of those dusty old guys who have been around for a long time, and my bald spot will prove that to you. But you might want to bring it to their attention that it's possibly and most likely one of these partial claim standalone liens, because if that's the case, you owe that money. That money's owed, so you're going to have to pay it back. But what they may be willing to do is issue the equity line, pay that lien off with the equity line, so it's now satisfied, and then move into second position. If they're not willing to do that, it's most likely because of the time constraints with satisfying that current second lien, having it recorded as, released, paid in full, so that the equity line can move into place. But I understand the frustration. A lot of people go through a forbearance or a modification not completely understanding what's happening. And I'm not suggesting that you don't understand. I'm just suggesting that it's confusing, and that most likely is what happened in this instance. And if you want somebody to take a look at it, we're happy to jump in. We might even be able to help arrange that equity line for you. So give us a shout off the air. You can do that by calling 855-462-7292 or hit mrmortgageradio.com and shoot us an email. I'll jump on the phone with you and see if we can't figure it out. Happy to review the paperwork and see if we can't help. But most likely that's what happened. You hear them say, we're going to put it on the back of the loan, and that's what happens when they do that. It's that partial, I think it's called a partial claim lien, but a standalone partial claim lien is what I believe the technical term with the FHA modification is. So hopefully that helps. That's a brilliant question. I haven't had that one yet, so I appreciate you making me work for that answer. That was a great question. Hey, Jen, okay, what do we have?
Trevor wants to know. My ex-girlfriend and I bought a house a couple years ago. We are breaking up and she wants me to buy her out. Can I do a HELOC in just my name to pay her off? Thanks.
Okay, so I'm sensing an equity line theme here, right? And now's one of those times that a lot of people think of an equity line because there's a lot of newfound appreciation. Although equity line interest rates are surprising a lot of people because they're tied to prime, and prime is now 8%, I believe. So if you've got an exceptional credit score, you might be at prime minus a point, which puts your equity line at 7. But a lot of people are seeing equity lines around 10.5%. So anyway, to answer your question, you could get an equity line in just your name. But here's the thing. If you're both currently on the mortgage and you're both currently on the deed, and your goal is just to quit claim deed her off the property and pay her off with the equity line, I'm not so sure she's going to go for that because she's still going to own the debt with you. So a lot of people are under the misconception that just quit claim deeding me off the property now frees me from the debt. But now you may be completely upstanding and perfectly manage your finances, and there's no downside to her as far as jeopardy of going through foreclosure because you're not going to lose the house. But if she goes to buy another house in the future, she's going to have you show that you are making the payment on the current property to enable her to buy the new property and not count that mortgage against her in that debt to income ratio. So a lot of times what seems like the simple answer, quit claim deed somebody off the property, is not the best decision for anyone involved, really. I mean, you may not want to go through a refinance because of the interest rates. I get that, but it's the cleaner deal for both of you long term. But to answer your question, you could do the HELOC in just your name. She's going to have to sign the papers, though, because she's on the deed. So, guys, you hear the music. You know what that means. That's my cue. We'll be back in a few. Sit tight. On the other side of this break, we'll be back with more of the show. Have you recently gotten a mortgage approval and now you're wondering, how do you know if it's a good deal? I mean, the wrong decision can cost tens of thousands of dollars in fees and interest rate. Is any of this negotiable? Is this a good rate? Guys, it's Mark Eitel, host of the Mr. Mortgage Show, and we are happy at no cost or obligation to you to take a look at that fee sheet for you. We'll go line by line through it, and one of three things will happen. One, we may congratulate you on getting an awesome deal, and then you can exhale and move forward knowing you did great. Or two, we may be able to point out some places in that fee sheet that you can go back and renegotiate a better deal with your current lender. Or three, and guys, this one's my favorite, we may be able to offer you even a better deal, saving you in fees or interest rate or both. Guys, there's no obligation. Just go to mrmortgageradio.com. That's mrmortgageradio.com. Click on that fee sheet review icon and we'll do the rest. It's Mark Eitel, NMLS 1929005.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel. This is the Mr. Mortgage Show, and your questions and comments are always encouraged and appreciated. If you've got a question, just give us a call or shoot us a text, 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. Jen is womanning that hotline. She'll get your questions on the air, 855-462-7292, or visit MrMortgageRadio.com. MrMortgageRadio.com. Scroll to the bottom of the page, click the email icon, and you can shoot us your questions that way. Hey, but speaking of your questions, Jen, are you ready? Okay, fire away.
Megan sent this one. I own a vacant lot. I'd like to give it to my daughter and son-in-law as a wedding gift. They will build their forever home on it. Will they have to wait before they can apply for a construction loan?
Hey, Megan, congratulations on the new son-in-law, and congratulations on thinking enough of him that you want to gift them the property to get them started. Anyway, to answer your question, assuming that the equity position in the property is enough to satisfy the requirements of the loan, they'll be good to go. It'll be treated as a gift of equity, and they can get started right away with the construction loan. Sometimes where people have to wait is if you purchase a property, you're given the purchase price of the property as the equity position. So if you paid $100,000 for the lot, that's what's going to be calculated, $100,000 worth of equity, if you will, in the calculation. If you need another $300,000 to build, you've got 25% equity. Now, after 12 months, the appraised value of the lot can be used. So after 12 months, if the property's worth much more money, then you use the higher of those two numbers. But that's in the case of a purchase. Brilliant, brilliant question. If you need more information around a construction loan, or if anybody out there has questions, because I know it gets a lot of people confused. Actually, let me just throw this out there. Probably the number one question we're asked is, do I have to pay for the loan during construction? Because oftentimes you're either living in a home now or you're renting a home. Now, this only goes in the case of a construction perm loan that you've initiated with a custom home builder. Now, when you go into a big neighborhood and it's, one of the big national builders, usually you just give them a deposit and they're building on their dime with their line of credit, and then you just take them out with a normal mortgage. But if you're going to a smaller contractor and they're going to get draws from your loan along the way, the big question is, do I have to pay that? Almost always the answer is no. The construction perm loan product has the interest required to service the loan during the construction is built in so that it's essentially paying for itself in the beginning. Once the property is completed, the certificate of occupancy is issued, and it converts to a mortgage instead of a construction loan, that's when the payments are started. So that's the biggest question we get. But I appreciate that, Megan. That is a great, great question. I hope I answered it. If you need more information, feel free to reach out. Hey, Jen, can you throw me another question?
Kylie has this question. Me and my husband would like to buy a house. We bought a franchise business 11 months ago. We've been told that we need to be in business for 2 years to get a mortgage. Are there any other options? Thank you.
Hey, that is another fantastic question. So you were told correctly some of the time. So there are loan programs that allow you to be self-employed for as little as 12 months. So in theory, you're almost there. You said 11 months. So by the time you start the loan process, you're most likely going to hit that 12-month mark. But that's going to be predicated on you qualifying for that program. So I guess the technical answer is going to be maybe, because if you qualify, you've got the credit, you've got the assets and everything you need, then you can utilize that 12-month self-employed. And it's a conventional loan program, normal interest rates, normal down payments. It's not one of the self-employed bank statement loan programs, but those two are available with as little as 12 months self-employment. So don't get wrapped around the axle with that 2-year mark. And guys, I say it all the time, and let me just take a moment to throw this out there. I suggest that you never take the first no. I've got a friend of mine, Christopher. He runs a brokerage in the Boston area, And he said something to me one time, and it's just a life philosophy of his, but I've always fallen back on his quote, if you will, as a suggestion. Don't take no as an answer from somebody that does not have the authority to say yes. And what I like to use that saying for is don't take the first no, because another provider of services might have access to additional programs or might have a deeper level of knowledge to utilize some of the programs. I mean, I've seen on so many occasions where somebody gets wrapped around the axle with a guideline, not completely understanding it, and then there's a plain and simple, easy workaround. I can tell you of one we're in the middle of. I inherited a transaction that was denied by a bank because of a medical collection. There's value in the property. We just increased the purchase price and we're utilizing the contribution to pay that off at closing. So, and there's more details to that, obviously, but there's ways around different scenarios. And oftentimes, no doesn't have to be no. It can be, well, maybe let me ask somebody else. Now, if you're dating, no means no. I'm not suggesting otherwise. But if you're applying for a loan, certainly initiate the conversation with additional lenders or additional real estate agents. There might be answers that would surprise you when you dig a little deeper. So, brilliant question. I appreciate it. Hey, Jen, do we have time for another one?
Abigail sent us this text. My dad died and left me and my 2 sisters a house. My sisters aren't interested in it, so I'm wondering if there is an easy way to buy them out. There is no mortgage on the house right now.
Hey, another brilliant question, and I've got to compliment you on using Abigail. I don't know how old you are, but a lot of Abigails are Abbies or Gales. But yes, to answer your question, that should be pretty easy to accomplish. You have 1/3 ownership, so it's going to be treated as such. Think of it like a gift of equity, if you will, where a parent is gifting that equity position and you're buying the property from the parent. It's essentially the same thing. You've got 1/3 in it already, so you can finance the rest in most instances, right? Assuming that you qualify for the loan program, you have the right credit, the right income, the right, everything you need to get qualified. But in theory, it's a fairly simple transaction. But a great question. We see a lot of that. And if you need more information or someone else has another scenario around that, I'm happy to share the experiences that I have with it. And then if someone needs access to an estate attorney or a real estate attorney, I'm happy to refer you to somebody there as well. So brilliant question. I appreciate that. Hey guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight. On the other side of this break, we'll be back with more of the Mr. Mortgage Show. We'll be right back. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards, and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. I host the Mr. Mortgage Show, and we are always here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are tuned into the Mr. Mortgage Show. Guys, we appreciate you spending some of your day with us. I hope you're having fun. We are having a blast with you. We've had some amazing questions so far, and we are going to keep those rolling here in just a second. But if you've got questions or comments, you can call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. Jen is standing by, womanning the hotline. She'll get your questions on the air. If you prefer to shoot us an email, you guys know you can just go to mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and send your questions that way. Check out mrmortgageradio.com. If you need more information, you can find just about everything out about me and the team. Well, not everything. That one incident back in college, it was one time no, I'm just kidding. Just kidding. I got to be careful. Nobody has a sense of humor anymore. But anyway, let me throw it over to Jen for another question before I get myself in trouble here. Jen, what do we have?
Ellie is asking, will the landlord loan you talk about work for a regular house in South Carolina? I will rent it, but it's just a single house in a golf club neighborhood.
Hey, Ellie, that's a great question. And the answer to it is yes. Assuming that the association in the neighborhood allows you to rent the property, the loan itself will work. And I appreciate you bringing that up because a lot of people associate that loan program only for buying, duplexes. It's actually the landlord loan itself is good to 8 units, and then we've got variations of it up to 100 units. So, apartment buildings and complexes. But I appreciate you asking that because it does work for individual single family properties. A lot of people use it to buy an Airbnb. And guys, if you don't know what we're talking about, that landlord loan program is really, really super interesting. Your personal income is not underwritten, assuming that your credit score meets the requirements and your assets. So usually you're putting 20 to 25% down with this loan program, assuming that you've got the assets with the reserve requirements. So usually 6 to 12 months reserves. So credit, check. Assets, check. And then the income side of things, we're looking at the property. So if the rental income pays for the debt, supports the debt associated with owning that property, boom, you're a landlord. It's super, super easy. It's all about cash flow. As we talked about to open the show, cash flow is king. And in this instance, that's really what we're looking at. So brilliant question. I hope that was answered. If you need more information, or guys, if anybody is out there interested in learning more about this landlord loan, give us a call. We're here. We're happy to help. We can jump in and help you if you need us. 855-462-7292. That's the national anytime hotline, but that also pushes to my office when we're not on the air. And as I mentioned, we are here and happy to help. So let me toss it over to Jen for another question. What do we have, Jen?
Nellie sent this text. Is it possible for a non-citizen to get a mortgage? My fiance is from Argentina and only has an ITIN. Thanks.
Hey, that's a great question. Yeah, I could tell by the look on your face. So guys, an ITIN or an ITIN is an individual taxpayer identification number. So it's issued to somebody who's going through the immigration process or someone who's temporarily in the country on a work visa. That's like a social security number in that it allows them to pay taxes into the system, but they're not yet a citizen. So there are loan programs for ITIN holders as well as foreign nationals and a variety of visa holders. So we do it a lot for people that are from South America and Central America, as well as Canada, and a few countries in Europe seem to be the majority of the incoming international population, if you will, to our area. So Nellie, great question. Yes. And you and he can both be on the application together. So it's interesting. There are opportunities for just about everybody who is going through the process to buy property. So great question. I appreciate that one. Hey, Jen, can you throw me another question? Okay. What do we have?
Solomon sent this one. This is not really a mortgage question, but we're making an offer on a house. The owner came back to us asking for 2 months rent-free to move out. We are on a month-to-month, so I'm okay with this, but I've heard some horror stories about this arrangement. Is there something we can add to protect ourselves and encourage them to move out on time?
So interesting, right? This is not uncommon, and it happened a lot during the height of the pandemic, although now with the low housing inventory, sellers are still reluctant because they're afraid that they're not going to go out and find their next home. So a lot of times they're looking for a 1 to 2 month cushion. Sometimes they're asking for more than that, but in most instances, if you're buying the property, Solomon, as your primary residence, your loan program prevents you from allowing them to stay longer than 59 days. Anything longer than 59 days, that property is going to be treated as an investment property that you're renting out instead of buying as your primary. So I'm assuming that somebody involved in the transaction knows that, because you said they're asking for 2 months. So that's encouraging, right? That's already one plus, if you will, to the negotiation. Now, your hesitancy is warranted, because I too have heard some horror stories. So depending on where you are, some states have tremendous advocacy for the tenant. So if you were to sign a 2-month lease, now their tenants, it may be difficult to evict them should they not leave. Now, this is just a suggestion. I'm not a real estate attorney, but I believe that money is probably the strongest thing to compel somebody to act, right? Money or freedom, I guess. And you can't take away their freedom. But if you were to have the contract written so a fair amount, a big chunk, a considerable amount of the proceeds that they were going to get at closing is held in escrow until they vacate. And I don't even know if that'll work. I don't know if they need that money to go buy something else or if this will work, but money seems to compel action. So my suggestion would be to see if there's a way to do it where they don't, maybe they leave, I don't know. I'm going to restrain myself from throwing numbers out there because I don't have the details of the transaction. But if they were not able to pull the proceeds out of the deal until they vacated, or at least a big chunk that would compel them to move on time, and then if they didn't move on time, there was a penalty that you were able to get more money. I think that's the way I would go. If you want to have a discussion about this and give me more details, I'm happy to give you some suggestions. If you're not working with a mortgage company, I'll jump in and help there if we can. But I too have seen some horror stories. The most recent one was a young couple buying their first property, and this was heartbreaking. They were buying their first property. We were not involved, and I'm glad that we weren't, from the sense that I hate the heartache that was caused. I wish we were, because I would have made suggestions along the way that might have prevented this. But anyway, long story short, they're buying a property that was occupied by tenants, and the landlord and the buyers agreed, even though the tenant was on a month-to-month, they agreed to give them an additional 30 days rent-free because the buyers felt bad that they were displacing this family. Well, guess what happened? They went and did their walkthrough on day 30, and these people hadn't even packed a sock or a t-shirt to move. They were fully there. They had no intention of leaving. The landlord had a laundry list of repairs he was supposed to do once these people vacated. That hadn't been started. It turned into a big, big nightmare. Litigation has been threatened. They're in the middle of it. I got a phone call because of the radio show, and I hated to hear this, but I understand your hesitancy and you wanting something to hold over the seller's head to get him out of there. So anyway, I appreciate that question. I hope that answer helped. If you need some more information, I'm happy to jump in and talk with you further about it. But I appreciate that one, Solomon. Good luck. If you need us, we're here. Give us a shout. Guys, you hear the music? You know what that means? That's my cue. We'll be back in a few. Sit tight. On the other side of this break, we'll be back with more of the show. Raise your hand if you are freaked out by what's happening in the banking world. Well, no, put your hands back on the steering wheel. It's all starting to feel like a house of cards. And what about that $17 billion, yes, billion with a B, dollars worth of bondholder money that was lost in that Credit Suisse takeover? Right now, I'm hearing more and more people talk about a flight to safety, and they're looking at gold and silver and other precious metals, but also rental property. Yep, income-producing rental property is starting to become sexy again. Guys, we've got an amazing loan program called the Landlord Loan. It's an easy way to acquire rental property. If you've got good credit and the assets, we don't even look at your personal income. We look at the income produced by the property. Assuming that it supports the debt, boom, you're a landlord. Check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005, and my team and I are here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel. You are listening to the Mr. Mortgage Show, and you heard the man. If you've got questions, you can call or text 855-462-7292. That is the Anytime Hotline. And Jen, my producer, is womanning that hotline, and she'll get your questions on the air. If you prefer to shoot us an email, just go to MrMortgageRadio.com. MrMortgageRadio.com. Scroll past all of that awesome information. To the bottom of the page there, you'll see an email icon. If you click on that, you can shoot her your questions via email. Hey, and speaking of awesome information, one new thing we added to that page was a link to our YouTube channel, and you'll find that at MrMortgageTV.com. Guys, we just built out a YouTube channel. Relax, there's nothing up there yet other than all the podcast episodes. But fun fact, we are getting ready to start recording the radio show, so you'll be able to see behind the scenes. But guys, be gentle, because I am not a dainty flower, nor am I a pretty face. I definitely have a face for radio, but we are stepping up with technology, and as part of the podcast, we will be videoing the radio show live, and it'll be up there on the YouTube channel as a live stream, as well as the recorded version. So be gentle, guys. As I mentioned, I sure ain't purty. Hey, but speaking of purty, and speaking of your questions, I'm going to throw it over to that dainty flower. Hey, Jen, do you have another question ready?
There is no name on this one, Mark. My husband was injured and can't work. We've been struggling to manage the bills, but without his income, we're not going to be able. He's a self-employed truck driver, and I work in an office. Can we get a cash-out refinance with just one of us working?
Wow, that's a tough one. First of all, man, I'm so sorry that you're going through this, but good that you have equity, right? So to answer your question, maybe, and it's all going to come down to, does your income alone support the new mortgage payment and then whatever debt is on your credit report? Because that's all we're going to be looking at. We'll look at your income, your debt, and then assuming that your debt supports it, you'll be okay. But it's definitely going to require a deeper conversation. And guys, this is the ultimate catch-22, right? Because you have the equity in this instance to lean on, but once the emergency happens, you don't have access to it. You know, a lot of people go and take an equity line and just put it on the shelf. They have it in case they need it, which is an awesome strategy, because what's the old adage? If you're going to jump out of an airplane, you better pack your parachute before you get on board. And that's kind of what happens in these instances. We've got a load of equity, an emergency happens, and then boom, there's no access to it because we no longer qualify. You don't want to wait until you start missing payments. You don't want to wait until you lose your job before you try to apply for either a cash out refinance or an equity line. I hate that this is happening to you, but I welcome the opportunity to have a discussion. I'm happy to take a look at your debt to income ratio. That's the term DTI, debt to income ratio, on just you alone. And we don't even have to pull your credit if you don't want us to. If you go on one of the free apps like Credit Karma and let me know what your credit score is and let me know what debt load is showing up on your credit report alone, we can do an income to debt analysis as well as take a peek at your credit score and see if that will work for you. But man, sorry that you are going through this, but thank you so much for the question. I hope that helped. Hey, Jen, do you have another question?
Caesar sent this one. My mom did a reverse mortgage a couple years ago. I just found out and want her to refinance it into a normal mortgage so I can make the monthly payments and preserve the equity. Can this be done?
Hey, Caesar, short answer is yes. You can refinance with no penalty a reverse mortgage at any time. But fun fact, you can make payments on a reverse mortgage. You do not have to refinance it into a forward mortgage. You can make payments on it right now to, quote unquote, as you mentioned, preserve that equity. You can even pay it down if that's your goal. So yeah, you don't have to do that. You can pay it as it is if you like. But as always, if you need more information, I am happy to help. And guys, that reverse mortgage balance does grow each month because it doesn't require a mortgage payment. And think about it like a normal mortgage. If you borrow $200,000, you don't just pay back $200,000. You pay $200,000 plus all that interest back. It's the same with a reverse mortgage, with the exception that interest is adding to the balance each month. So it can be scary to watch that balance grow, but that's the trade-off for not having to make that monthly payment. But great question, Caesar. I hope that helped. And just in summary, you can make payments against it now if you want to try to keep that equity position the way it is. But I appreciate it. Hey, Jen, can we squeeze in another one?
Wendy has a question. For the second year in a row, our homeowner's insurance premium is jumping. Is there an easy way to figure out the minimum insurance we need to keep our mortgage company happy? Thank you.
Hey, I'm chuckling because is the mortgage company ever really happy? I know it's super frustrating. It's happened to us, I think, 2 of the last 4 years. So I definitely understand what you're going through. Better to get the premium increase notice than that dreaded "we are not going to renew you" notice. That is never fun. But to answer your question, you're required to carry the replacement cost or the mortgage balance, whichever is less. So take a look at your mortgage balance, and then when you're looking at the policy, they're looking for the language that says replacement cost, full replacement cost, not depreciated. That's the language that the mortgage company prefers because they know in case of a total disaster that the full replacement cost of the property is insured. So that's the big caveat. But know that it's the replacement cost or mortgage balance, whichever is less. And if you need help with that, just give us a shout. I am always happy to discuss that in length. Hey, Jen, let's see if we can get in one more.
Nick sent this one. Is a cash out refinance or HELOC better for a remodeling project? We owe around $225,000 and need probably $100,000 for the remodel. The house is worth around $615,000. Thanks for your help.
Hey, Nick, that's a great question, my man. And you've got a great equity position. So it's really going to come down to preference and debt management because most of the time, and this is just a most of the time scenario, you're going to do a cash out refinance and then have that fixed monthly payment for a long period of time because you're talking about roughly $100,000. So with the home equity line of credit, you certainly have enough equity to do it, but that equity payment is adjustable. Sometimes there's a 10-year interest-only period associated with it. So you could get after that debt and pay it down in 10 years. Then that's awesome. But those are the caveats, right? So the home equity line of credit is adjustable with prime. So every time the Fed increases, so does your equity line. And right now, prime's 8. So a lot of people are paying somewhere between 7 and 11% interest on the equity line, depending on your credit score and the amount of equity that you've utilized. And then the cons of the cash out refi are that you're disturbing that first mortgage interest rate, which might be amazingly low, but then you are now extending that debt over most likely a 30-year period. But it's a stable fixed rate payment. It's not going to adjust, and you can buy that interest rate down. What you want to look for is the blended interest rate of the equity line and the first mortgage versus the cash out interest rate of the second strategy. So brilliant question. And if you need help figuring out that blended rate, just give me a call or shoot me an email. Or if you want to Google blended rate calculator, that's probably the easiest way to figure out the math behind it. But brilliant question, my man. And I appreciate that one. Uh-oh, guys, you hear the music? You know what that means? That's my cue. No, it's not my cue. Oh, no, it means we've wrapped up another week of the Mr. Mortgage Show. My God, where does the time go? We've had a blast. I hope you have too. Jen and I will be back next week right here, same time, same station. If you need us during the week, check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. Have a fantastic week. We'll see you next time right here.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages, right here on The Mr. Mortgage Show.
Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.